Thank you for joining us. This is the Traders Exclusive Live Trader Showcase. I'm Sherry. Please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. So before we get started, I will share the quick disclaimer. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time, and past performance is not necessarily indicative of future results. Many thanks to our sponsors for the June Live Trader Showcase, Market Taker Mentoring, TechniTrader, and Money Mentor. Please go check them out at markettaker.com, technitrader.com, and moneymentor.com. Thank you again.
Appreciate you all for being with us this morning. Thrilled to kick off day 3 of the Traders Exclusive here, quarterly event. And I'm Price Headley, but glad to be with you to share with you what we're focused on here at Big Trends. You know, like Sherry said, we're looking for significant moves. Basically, we want the big fish. We don't want the little fish in our trades, right? We throw the little fish back. We try to skip those, actually. We try to pass on small opportunities and look for the bigger opportunities. So we're looking for big moves in relatively short periods of time. So one of the things that's been working really well for us is low price options, buying cheapies, relatively, not the cheapest of cheap, but relatively cheap options where you get some tremendous leverage, but you manage the risk. We're going to talk about both sides of the coin because let's face it, when you're trading as long as I have for 35 years, you stay in the game by controlling your risk. That's your first thought. Your first thought is not how much can I make, it's how much can I lose. Okay, why would I talk about that? Because I want you in the game for the long haul, right? I want you to figure out how to start doing this as well for decades and for the rest of your life, and really benefiting you and your family for the long haul. So we're going to talk about that. This strategy's been hitting. Typically, we look for doubles, then triples. That's where the 200% kicks in. Obviously, there's risk in every trade. So we've got to talk about our disclaimer quickly. The information provided in today's presentation based on our proprietary research of Big Trends is intended for illustrative purposes only. You should not consider these specific advisory recommendations. As you know, stock and options trading have large potential rewards, and they also have large potential risk. The past performance of any trading system or method is not necessarily indicative of its future results. Do see our terms of use on our bigtrends.com homepage for more information. If you don't know me, like I said, I've been trading options for 35 years, started in April of 1990. I founded bigtrends.com, like Sherry said, back in late 99, November of 99. So we're on our 25th year, serving tens of thousands of folks all over the globe. And my philosophy has always been there's got to be a system, a quantitative edge. Everybody's all hyped on AI, artificial intelligence. And that was the big breakthrough for me when I was launching Big Trends, was the internet and computer power being the guide to filtering thousands of potential opportunities. Actually, you could say millions of theoretical options that you could be trading, because there's thousands of optional stocks, and each one of them probably has hundreds, if not 1,000 plus optionable choices, right? 1,000 times 1,000's a million, right? So we're filtering that million plus down to a handful, and ultimately to our favorite trade at any given point in time, right? That gives you a lot of confidence and a lot of clarity. And frankly, it takes the chaos and it turns it into order. It makes it to where you can follow along. And we actually send out these trades real time to our subscribers. So for me, quick history lesson, I got the trading bug actually when I was reading about stocks in the Wall Street Journal back in 87. The crash happened in 87. I was like, this is really interesting how historic this thing was. Of course, everybody's predicting the end of the world after that. Didn't happen, right? The doomsayers are often wrong. But the idea was, I was like, okay, well, let me enter this trading competition, and should be a good time to value buy some stocks after the crash. In the long haul, it was. But in the short-term contest of 4 months, it was a AT&T Collegiate Investment Challenge. I was taking Warren Buffett's approach and got my statement with a month left in the contest. 3 months in, I was in the bottom 25% of participants, buying Coke, buying Procter & Gamble, buying Gillette. I remember were 3 that I thought you can't go wrong with those, right? Well, I was going wrong. And I was like, it's time to do, if it's not working, guess what you got to do? You got to do something different. If your strategy is not working in the markets right now, you're in the right place to learn from me and a lot of other fellow traders and see which one resonates with you, that you might start trying something different to boost your results. I went to an active trading approach, didn't really intend to do that, but I noticed this pattern that back then there's a lot of takeover rumors, and I was noticing that a lot of those stocks would pop up on the rumor, and then the next day they'd pop back down. So I was kind of fading the rumor. This was with paper money, of course. I wouldn't necessarily recommend this with real money, but the idea with that I noticed was that this pattern kept happening, and I went from the bottom 25% to the top 1% in just that last month of that contest. I remember February '88. I think my school studies went down while my paper portfolio went way up. But I realized at that point I found my passion. I found what I wanted to do, and I found the way to do it was to find a pattern that you can see repeat and that you can continue to kind of rinse and repeat. The names and symbols will change, but then you can still keep benefiting from that pattern playing out over time. So for me, after graduating from Duke, I became an analyst and ultimately head of research for the nation's largest options newsletter in the 90s, left there in 99, and then started BigTrends.com later that year after playing golf, taking a 6-month break and realizing that I like golf, but I didn't love it as a passion like I love trading. Wanted to be back in the markets, and so I launched BigTrends.com to really show people the quantitative side of how we do things. And so blessed by so many that have supported Big Trends to make it 25 years in business this year, and thrilled to hopefully be doing it for a lot longer, God willing. So the bottom line is that probably the biggest break that we had at Big Trends in the first year of our business was I got featured in Barron's magazine where I said, "Watch out below," and that's not my normal modus operandi. I tend to be more of a glass half full person, looking for the opportunities, the upside. Generally speaking, you can make a lot of money on puts, but on trading the downside, but you can also see that most of the time stocks are going up in the super long haul view, right? So we were saying something like, watch out, everybody else is bullish on tech stocks and these buying the dip so aggressively, and yet these stocks keep dropping. It's like, watch out below. And of course, that was the start of the collapse of the tech bubble, right? You could say we're in a bit of an AI bubble, and the question is, what inning are we in? It's a great question, and I would say, I'd say we're probably 2/3 of the way through that game from a stock perspective. AI is real, it's legit, it's going to impact things, but the point is, from a stock perspective, stocks discount that way into the future. They get way ahead of it, right? So a good reminder, a little side note is like, think of Amazon.com. We all know Amazon.com was the big winner out of the first big tech internet wave in the late 90s, right? And yet, if you bought Amazon at the start of the 2000s, you had to write it down some 90%, losing 90% of your portfolio, of your stock value, and have the confidence to stay with it through that incredible drawdown to be around for the bigger win, right? So the point is that, and most money managers would tell you it's unacceptable to take that kind of a drawdown, period, no matter how good the stock is, right? So you've got to be able to say, I need to protect myself from when things get too bubbly and too hypey. And that's why I'm saying I'm not really a fan of the idea of buying and holding the stock market right here. I think that we're due for some kind of a shakedown. That's what our work will do, is it will take advantage of both the upside quick pops and the downside quick pops. So that kind of put us on the map. And then fast forward a few years to 2007, had the honor of being inducted into the Traders Hall of Fame, sponsored by Traders Library, joining a lot of what I would consider my trading heroes that I learned from. My goal for you through these various traders that you're learning from today and throughout the Traders Exclusive days here is to really benefit from what other people have put countless years, if not multiple decades, for me into the markets, and hopefully point you to a quicker way to not have to invest so much time and get you to where you want to go that much faster. But it always starts with education, right? We're a big believer that you want to be in that constant education mode throughout your trading and investing career, right? So you're in the right place. So how do you find today, we're going to key on, how do you find these home run trades, right? And home run's a relative term. I mean, for me, it's a double or a triple in about a week to no more than 2 weeks is our relative home run for such a short time frame, right? We're looking for those. They're not going to happen every time. There's going to be trades that lose, right? So we have to say, okay, does this basically shake out in the wash to be an effective strategy through the winners and the losers? And this is something that's been one of my favorites. That's why I want to share with you today. So I'm going to give you some success stories of what good trades look like, also what it looks like when you take a loss, right? So the idea is that you've got to manage both sides of the equation. We're not teaching fantasy trading here. We're teaching reality trading, and managing both sides is something that, frankly, a lot of traders and investors are not good at. They don't manage their losses well. They let their losses run to get small losses turn into bigger losses. Meanwhile, they take their winners too quickly when you need to let your winners run, right? So that's what we're going to teach you, this home run options trader strategy, how you can make up to 200%, up to a triple in a fairly short period of time on trades that are working like they're supposed to, right? So the idea here is that let's look at a recent winner, then I'll go into more depth on how the strategy works, knowing that, of course, in all these examples, past performance is never a guarantee of future results. Future results are going to vary. So here's an example we did with Moderna. mRNA is the ticker symbol. And Moderna, of course, was one of the big winners during the COVID run in post, the first quarter of 2020, coming up with a vaccine to basically handle the COVID pandemic, right? Pfizer, of course, another one of those that was a beneficiary. But Moderna went up a lot more in that phase. So what are we looking at on our bottom panel here? We've got two different indicators, and we pulled this out of the Thinkorswim, now Schwab platform here. And what we did is we said, okay, look, you can plot this yourself. I can't give you the parameters, but I can tell you the indicators. This middle one here, you see it says BTTK, which is our BigTrends toolkit, available for Thinkorswim, like I said, now Schwab, and also it's available across a couple other platforms as well. CCI. CCI stands for Commodity Channel Index. And you can see CCI is telling us that we're breaking out above our overbought boundary here on this hourly close right here. Okay, so this hourly close in the stock when we got the Moderna signal is trading about 127, let's call it. And you say, okay, the other indicator on the bottom panel is Larry Williams percent R percent range indicator. Now again, I use these totally differently than most people would use them. When something goes quote unquote overbought, that's supposed to be bad, right? Both of them are going overbought together. And this is back here earlier in May. Both of them are supposed to be a bad sign when they go overbought, right? But in our experience, if a stock is going higher and higher and higher, is look at this chart here. I'll just take off those markups for a second so you can hold on. I'll go back to that so we can look at that and say take off the markups again and say what's the best time to be on this when it breaks out into that overbought territory and stays in that overbought territory, right? So we will get times where we get what we call retests, where you see both of these are coming back under their overbought threshold right at this key low here. And you see it tests it, but it holds it, and we keep on going. We get another retest back here, this other short-term low. These retest levels can be very valuable for reentry once you've got a confirmed breakout signal. But the first thing that has to happen, folks, is that basically one indicator is not good enough. We got to get both of them signaling on that same exact point in time that both of them are breaking out, right? So my philosophy is quite different, as you can tell, than the masses. The unconventional wisdom is that the overbought modes is where you will make your best upside money if they go overbought and then stay overbought and follow these parameters like they should. Now, when I say should, why should they? Because let's face it, you and I as individuals are not driving the stock market. The institutions are driving the market. We all know that intrinsically, right? The big mutual fund players, the big hedge fund players, the big investment banks and other banks, and we're talking about billions and billions on each of them that they're controlling, whereas you and I, if we're controlling 100,000 or a million, we're still small fish in the bigger institutional pond, right? So what we're looking for here is that when institutions start wanting to buy, they don't just stop buying just because it's going higher. They basically have a belief that there's something going on with this name. They want to build their exposure steadily and consistently, but it takes them more time than it takes you and me. So that's the advantage you and I have, is we have speed as our advantage, but the institutions have size as their advantage, right? They can keep plowing it in, plowing it in, plowing it in, and keep riding some good news that they see coming in the future, and they want to be in ahead of that, right? So my view is that I don't have to know what that good news is. I just have to know that the big money wants to get on board, or when they want to get out, we'll show you how they want to get out and just sell steadily, and we can benefit from those downtrends as well. But the uptrends, you can see Moderna is starting to move. Now, here, what option do we buy? We get the signal here earlier in May. We buy the June monthly. So we go out a little over a month till the expiration here, and we don't expect to need that much time. But the other thing that we do is we say we want to find an option that's trading under $1. So we paid an average of 86 cents, meaning multiply that times 100 because each option contract controls 100 shares, right? So we pay $86 to control 100 shares of stock when the stock's trading at about 12,500, just over $12,500. So you can see where our leverage here is obviously tremendous at a theoretical almost 150 to 1. But that is theoretical because, of course, the more time it takes, the more that leverage will be cut by some time erosion. But this is why when you buy any option, you must have the trend overcoming the loss of time that you're going to experience as an options buyer, whatever type of option you buy. Even if you buy an in the money option that has a little bit of time premium, you still have that time at risk. But what we found is that when you buy enough time, say you buy a month out before expiration, you've got as Warren Buffett would call it, a long enough runway to say, okay, if I buy a month out and I only need about a week for this move to transpire, to develop, then I've only lost 1 week out of the 4 weeks or so it had before expiration. So I've still got 3 weeks left. So even if nothing happened, I've still got a decent amount of time left. I haven't cut it too close to the razor's edge. And we won't hold any options here with less than 2 weeks to go before expiration. So while everybody else is out there raving about 0 days expiration as such a great strategy, yes, it has its opportunity. It also has more risk, right? When you have such a short runway with no time left, if you're buying options that are expiring at today's close, you right now would have about 6 hours to go before the options expire, right? That's a pretty short runway. We're giving ourselves, 30 days, 20 market days or so, when you take out weekends and whatnot. But the idea is that look at what's happening. The first day or so in this trade, not much has happened, right? It started to go up, then it came back down and retested right back into the area where we buy. So we're not making money 24 hours later, right? We're basically flattish. We might even be down a hair. This goes to another point that I believe that's so important, especially when you're taking a more aggressive growth strategy, looking for bigger winners, is that you don't want to get shaken out by a little bit of market or stock noise, right? So that little shakeout, like I mentioned, that first pullback there by Wednesday morning is what we call a retest. That's kind of the key little flush point that's happening that morning. And what we believe is that you don't want to put price stops on these trades from the get-go. And I know that's very controversial, but we would say instead what we want to do is use what we call time stops to get started. So we've seen trades that will be down 25, 35, even 50% in an out of the money option and still manage to come back and end up being a doubler and a tripler if the chart structure is still in our favor. So when we get that retest that Wednesday morning, it holds and then we rally back up. We will track the time stop approach by looking at the end of the day. And by the end of that day after that retest, you can see that we were above where we bought. Stock had rallied up above 128 by the end of that Wednesday, right? So we were still above where we got in near 127. So if we're equal to or above where we got in, we say, look, the chart structure is still saying we are justified to hold this trade. And so each afternoon, that last hour, if it was below where we got in the following afternoon, then we would say, okay, we're going to go ahead and hop out. And so we will alert subscribers, send a real-time email, 3 o'clock to 3:30, time to get out. Time stop says we're not getting the lift that we expected, right? Because if you get on a rocket ship and you expect it's going to take off and then you just end up sitting there, or worse yet, it's going the wrong direction, it's like, okay, I need to hop off of this one and move on to one that can truly take off, right? So that's how we manage the first part of the trade with the time stop, not with the price stop. You don't want to get flushed by just a little bit of noise. It's very easy to do, by the way, to get flushed with an out of the money option, right? Because look at what strike price we're buying. We're buying a 155 strike call. Stock's at 127. You say, hold on, that's like 28 points out of the money. That's more than 20% out of the money. It's got to go up to 155 to make money. That's the fallacy. It does not have to get to the strike price to get you a double or a triple. It just has to get closer to the strike price where it's less out of the money. So what you just need is to find that quick speed of movement phase. So I spent a lot of time on this chart to just kind of walk you through a lot of the principles of how you can be successful buying out of the money options. A lot of people are not successful with that because they just hold their dogs too long. They hope they eventually are going to come back. They rarely do. and basically at the same time, when they make a little bit of money on the upside, they get rid of their winners too quickly. So where do we cash this thing in? You can see the following Monday, it's now ripping up. Remember, we bought it about 127. Here it is up to about 135 or so. We're up about 8 points, which is in percentage terms, what, about a 7% move in the stock. So the leverage actually ends up being something more like 14 or so, 14 or 15 to 1 by the time a week later that we're making our first target at a double. What do we do at a double? We sell half of our position at a double. Why do I do that? It's the free trade rule. You get your risk capital back when you sell half at a double, and then you can let the other half run and see if it can get onto your next target. So our other half target is the triple, the 200% gain, which you can see we're getting out 135, and then a few hours later, remember this is an hourly chart, 3 hours later, it's up to over 142. Now, we still haven't gotten to the 155 strike price, but we have rallied now. Even that next Monday where we're cashing out, going from 135 to 142 is a 7-point move. We made another 5% or 6% move in the stock intraday. And so that extra 5 or 6% is good for that extra 100 percentage points from 100% to 200% on the second half. So we average 150% gain on the position. If you were buying $1,000 worth, you can see like 10 contracts would be $860. 11 contracts would push you up into the $950 range, and you're going to make in this case, if you invest $950, you're going to make something like $1,400 or $1,375, something like that, before commissions. And again, commissions are tiny compared to what they used to be. It's $1 a contract or less with no minimum ticket charge anymore. So it's a great time to be an options trader. So the point is that that's all happening in a week, from a mid-Monday one week to a mid-Monday the next. Okay. So what's the secret? Well, part of the secret sauce is buying the lower price options and not being afraid to buy an out of the money option. In this case, it was more than 20% out of the money. Let's face it, if it never moves, even if it moves up slowly and you don't have a plan on how to get out of that trade, you could lose 100% of your investment in an out of the money option, right? Because an at the money or out of the money option has no theoretical intrinsic value. Intrinsic value in that example would only kick in when it got over 155. That's why we don't hold and hope for the quadruples and the quintuples and the 10 baggers. We basically say, look, take the double and the triple when you get it, because the goal is to hit it quick, get in, get out, put that money, that profit into your account, and then keep building that over time, but always being slow and steady on your capital allocation. I don't care how many winners you've had in any system in a row. The idea is that you want to be consistent in your capital allocation. Don't just ramp up, say, I was investing 1,000 a trade, now I'm going to invest 5,000 a trade. Make it a much more graduated approach, so you can say, look, I'm not going to overcommit on any one trade. We believe a lot of this leverage from these cheap options priced at $1 or less, meaning $100 or less per contract. That cheap option is getting benefited by the trend, and it's also getting benefited by the fact we call it the gamma boost. What does gamma boost mean? It means, if you're looking at the options Greeks, delta is how much your option will move for a 1-point move in the stock, right? So you get a 1-point move in your favor. If the delta's on these out of the money options, the delta might be 30%. If that means you would stock moves up $1, your option moves up 30 cents on the dollar. That doesn't sound like much. But then if the next point goes up to 35%, on the second point of delta, then that would be called a gamma of 5%, from the first point at 30 to the second point getting you 35% of the bang for your buck. You're picking up more deltas as you're going from way out of the money to closer to the money. And then of course, deltas keep on growing as you go from out of the money to in the money. So the thought is, okay, we want to trade for these multiple points, or in that case, we were just showing you the 10 to 15 point type of move in the underlying stock that gives you this massive gamma boost, that gives you the kind of leverage on each successive point, actually seeming like it's adding even more to your growth, right? So this is why we don't just kind of play the scalping game of trying to pick up our gains on the first point move in our favor, right? I have to warn you, of course, it's not as simple as picking any old $1 or less option. And some would say, oh, why not buy 10-cent options, because that would give you even more leverage. Well, then you're needing stuff to just be way too dramatic of a move, and those options have a very low probability of success. We know that we're trading options that by the market standards are not expected to have the success we're getting. I believe it's because we have such a trend advantage. And the reality is the options pricing model does not take into account trends. It assumes you can't predict trends. It assumes the markets are perfectly efficient. Therefore, it assumes that prices are where they're going to be going forward. We all know that that's a fallacy, right? Prices continue to trend and continue to move because I believe the institutions are adjusting to knowledge that they have of what's coming up next. That's my theory. But the key is that trends exist, and that's your biggest advantage against the options pricing model, especially as an options buyer. So again, I'm going into a lot of the depth here of why you have an advantage with this methodology here and why you can take advantage of the markets on a regular basis while still managing risk when it's not working. Now, every 60-minute bar for us can be a new trigger. We're typically looking in the window once we get the first hour or two out of the way. We're usually especially looking in the window here between about 11:30 Eastern time, 2 hours into the Wall Street Open, till about even 2:30 or even possibly 3:30, but usually that 11:30 to 2:30 kind of sweet spot for us as an entry area, each hourly close on the bottom of the hour, right? Because you start off trading at 9:30, so 10:30, 11:30, 12:30, etc. Okay, so we're going to look for those momentum moves. If we get both of the indicators, we call double confirmed, meaning they both signal fresh breakouts together on the same exact hourly bar. And it's a little hard to do because the time frames we use for the two indicators are a little different. The parameters are different. So we're kind of looking at like two different rivers of time, if you will, flowing together at the same time to tell us that we're going to get a more powerful, bigger trend river, if you will, that we can take advantage of. Okay, so the beauty is it's ideal not just for bigger or medium accounts, it's actually ideal for smaller accounts too. So if you're just getting started, you can let the system prove it to yourself, right? We would say just get at least 2 contracts per trade, meaning you could theoretically get started with as little as $200 a trade. Because you want to give it a chance to double the first one and then triple the second one when it does what it's supposed to do. And so 2 contracts would, and of course you don't have the commissions ticket charge issue anymore. So it's totally scalable down to even just a couple of contracts. So what's our setup here? We want to see both that Williams %R% range breakout and that CCI commodity channel index breakout. Now, I'm not using on commodities. I'm using on a big name growth stocks, right? So the philosophy here is that we want to get both of those breaking out together on the same hourly close. The other thing we do is that we run them through what we call a historical profit factor review. So we go back at least 10 years, sometimes as much as 20 years, to verify that this stock has been good with this home run options trader system, right? If it's a name that you thought would have been good and you look back and you're like, okay, it's not as good as I thought it would be. It's barely better than a coin flip. That's not acceptable to us. Okay, we're going to say, look, we're looking for a meaningful edge way over randomness to say that it's worth the risk capital that you put in the trade, right? So why would you put into a trade if you think it's not worth that risk capital, if it doesn't give you enough of an edge? There's plenty of other fish in the sea, as it were. Let's find the bigger fish somewhere else. Now, we give you, I can't give away the settings here for free, but I can tell you when you get signed up, which we got a great special traders exclusive. It's been good to me. I wanted to be good back to say, let me go ahead and give you a great special to get started here in just a little bit. But let's also talk about some more charts first. So, and also just a reminder on the one trade is a trade, right? That doesn't mean anything, but what does it mean when you look at the longer term history of all trades, winners and losers, win, lose, or draw here, everything's included. Again, past performance will never guarantee future results. This looking backwards data goes back to the beginning of 2021 through today on all closed trades. Okay, so the beauty of this that we're looking at here is if you took a $5,000 account, you said, I'm just going to put in $1,000 a trade on every trade, right? So if we're buying it for $1, that means you get $100 in per contract. That would get you 10 contracts. These are before commissions. They're before subscription investment. Okay, but it includes all winners and losers. So you look at that and you say, well, we're not compounding that amount we're putting into the next trade and the trade after that. We're using the same $1,000 even after it's grown from a $5,000 portfolio up. In this case, you can see to basically 19,000, making over $14,000 gross before commissions. That's as you can see, a near quadruple since the beginning of 21. When you think about it, 21 was a bullish year, but it was kind of a choppy year. That was more the meme stock year with GameStop and AMC and those names. But then 2022 bear market, S&P down 19% in 22, recovered those losses in 23 with a good bull year, but basically still was relatively flat over that 2-year 2022 and 2023 window, and now up a bit with the rally we've had so far near the halfway point of 2024. So the idea is that the market hasn't done that much. It's up a bit, but it's not up anywhere near this. So this is really crushing the market. If you like to compare how you would have done being just invested in the S&P, you'd be way ahead. Right now, we can't guarantee in any period in the future that you're always going to be ahead by that much. There's going to be times where it's up, times where it's down. But the idea is that it's about letting the system play out for you. The beauty is it's scalable. That's why I always tell newer subscribers, start small, build up, let the system prove it to you so you can then prove that you can turn a small account into a medium account and ultimately into a bigger account as you get proof of that by watching the system signals, and then you can scale up gradually and accordingly. But always starting small is a good rule. You say, well, what have you done for me more recently? Well, we just look at how's our return since the beginning of March, let's say, looking back over about a 3-month window or just a hair over 3 months here. You can see that a $5,000 account would have made $3,800 of gross profit. Again, adding up all winners and losers before subscription investment and before commission. That's with the same $1,000 invested per trade, right? So you'd be up like 76% gross, even just in the past 3 months and a week on top of that. So the point is that over 13 weeks, that's a pretty healthy return. I again would not guarantee future results. They're going to vary. What's not going to vary, though, is our commitment to following the system, right? As I say, the symbols are going to change, the names will change, but the system remains the same. So it's our job and ultimately your job when you become a subscriber to say all you have to focus on is execution. You don't have to play any more of that game of like, do I have the right system? When should I get in? When should I get out? We take care of all that for you. We never leave you hanging even on trades that aren't working. Okay, we will tell you how to get out of every trade, win, lose, or draw. So here's one that we had with MPC. It's Marathon Petroleum. The energy stocks, of course, starting to see some takeover stuff happening in there in that sector. But you can see there's the launch kicking off there. We're going back here now into March. We're buying the April 200 strike calls. When we're getting that first breakout happening here, you can see that we're getting in here in the neighborhood of about 180. So again, we're about 10% out of the money buying a 200 strike call out about a month before expiration. And here's a great example where initially we are incorrect, okay? So you can see here these first couple of days in the trade, that Thursday, Friday, we're about flat Friday. We're down Monday morning. And you think, uh-oh, they're going to be below where they got in. But look what happens by the end of the day. By the end of the day, we're back above where we got in. So it managed to just hang in there. And that's why the power of using the time stop. If you'd use a price stop, I guarantee you would have been stopped out. I guarantee that you would have, by Monday morning, when it's gone from 180 down to 178, 177 and a half, you think, well, that's not that much of a move against me here, maybe a percent and a half. But you're losing a little bit of time, you're losing price action, and people are bailing, right? They don't have the conviction to stay with it. You can see on the CCI that actually was just a classic kind of a retest right there. And so percent art had its retest the day before, kind of similar levels. So but the point is that, okay, let's go on and keep on looking here back to the chart. That look, what we're seeing is that the philosophy is keeping us in the trade that's going to ultimately be a big winner. Think about this. Even if you're like, okay, well, I only took a 25% loss. I kept my risk down, took a 25% loss. You can see this trade gets both of its objectives, makes 150%. That's 175 percentage points that you left on the table. You've turned a winning strategy into a loss by putting a price stop on it when you should have used a time stop. So to me, the time stop gives us enough of a window to say uncle and still limit our risk, and at the same time, not get whipsawed. So that's there's some eye openers I hope I'm giving you today. One, that overbought's not a bad thing. In fact, it can be powerfully good and might just explain why you've been missing out on a whole bunch of big winners. might just explain how limiting yourself by basically some other faulty training you might have gotten in basically just about every other textbook that suggests that overbought is bad is actually costing you a lot of opportunity. So, when you think of limiting mindsets, that's the one I want you to break through today and give you this opportunity so you can start taking advantage of a whole new way to take advantage of the markets and trade the markets without those kind of limitations, but still having a plan, right? It's not just buying and holding and hoping, right? It's saying, look, we've got a plan on how we're going to stick with the trade. We've got a plan on how we're going to hang on if it's working, and also a plan on how we're going to get rid of the darn thing if it's not checking all the boxes of why it should be held. So we paid 92 cents, 92 bucks a contract, controlling 100 shares. 100 shares would have cost us $18,000, right? So you can see your theoretical leverage here is almost 200 to 1 as we get it started. Obviously, we have to wait through that sideways, even against this pattern at first. You can see we got in on a Thursday. By the following Wednesday, that's when the stock has this rocket ship launch to the upside. Because of our rules, we're still on this train. And you can see it's now gone up here to just under 190, about 188. So we're getting that first half out there at a double back in the mid 180s, about 186 maybe is about where we're selling out. At the first target, of course, would be $1.84, $184 when we paid 92 bucks. And then the triple will be 3 times that 92 bucks. So I'll guess in there at $2.76. And you say, well, hold on, it's only getting to 188, 189. How are you getting out of this when it's a 200 strike call and it's not anywhere close to the strike price? It's a lot closer to the strike price than it was, right? We've cut the 20 points out of the money distance down to just about 10 points out of the money with just under a week of time lost, and still plenty of time left before that third Friday of April expiration typically. So you say, okay, look, that's the goal, is to be around for that. So what this time stop approach I've taught you here today will do for you is it will give you more staying power. It will give you still a reasonable uncle point to get out of the trade on a given afternoon, and we'll remind you that it's not holding, let's get out of it, or no, we're still holding it. But the key is that you're not in that kind of just whipsaw fake out dynamic that so many other traders are living through on a constant basis, right? We want to kind of change that dynamic dramatically. Here's a much slower mover that still worked out real nicely for us, Bank America. You think of bank stock, it's not your traditional tech stock, your traditional big mover like Moderna or whatever. It's slow and steady, right? But again, Bank America checked the boxes for us back in March. We said, look, stock's trading here maybe in the 34 and a quarter area as we get our signal. When both of these break out together, you can see it happening on the chart there. And then we're buying a 36 strike call. So we're buying a little bit out of the money. You see, we don't have to go nearly as out of the money because it's not priced for that kind of volatility, right? It's priced as slow and steady. So we're buying it about maybe 5 or 6% out of the money. So we need that first move does get to the strike price. You can see it's slow for that next day after we get in, then it starts to really rip. And as it gets up here, it's up towards the strike price. At the strike price, we paid 73 cents. Now that's worth almost $1.50, right? $1.46 is our exit. And we sell half of it at the double. We never sell the whole thing at a double. Don't make that mistake. Sell half of it at a double. You're feeling pretty smart about selling half and getting your proverbial free trade, because then over the next several days to almost a week, it ends up taking a sideways move there, right? It ends up kind of just chopping back and forth. Once we've got the 100%, we will create trailing stop rules, so we'll protect profit on the second half of our position. But remember, you do have no risk in the trade once you've taken a double on half of your position. Even if the other half went to zero, the worst you could take would be a break even on the whole trade, right? So you can see it's choppy for a week. Remember, we've got plenty of time here. And so then it rips on up here to 37.5, almost 38. And now we're selling the second piece out at $2.19. And it's pretty much an intrinsic value play right here, as it's about $1.50 to $1.80 in the money, right? So not some time left, but not a whole lot of time value left. So that one needed to go from out of the money to in the money because it was such a cheaply priced stock option, but we bought it closer to the money to begin with, right? So the point is that staying power, once you sell half of the double, it frees you psychologically to not be sweating the trade so much. And so Bank of America worked nicely. Here's another one with Williams Companies, another energy stock. WMB. We didn't have to pay that much time, we didn't have to go out of the money at all. You can see that we bought the at the money 37. It was about $37.10, or even a hair in the money, buying the 37 strike calls for 93 cents back in March for the April monthly expiration. We always stick with the monthly expirations to give ourselves about a month of time before we expire. So you look at this and you say, okay, we catch that steady rip to the upside. This thing is not priced for even a quick buck rip, right? It got about $1.50 in our favor. And so our 93 cents turned into $1.86 on that, in on a Monday and out on a Thursday morning, just a few days later. Plenty of time left, right? And we've ripped about 1.5 points is about a 4% move in the stock, right? So 4% move in the stock, good for 100%. That's a 25-to-1 leverage, pretty healthy. You can see, look at our indicators. Look at how, especially the CCI goes vertical, and look at how that percent R, after a little pause, that second wave just stays overbought. I jokingly call percent R percent T when it goes in these modes. It's not a range anymore, right? What is it? Is it makes higher highs and higher lows. What do we call that? We call that an uptrend, or a trend. It's called percent T as percent trend. We want the trending phases in the top 20% or bottom 20% of the readings. We want to leave the chop in the middle of that range to everybody else, right? That's the little fish in the middle. The big fish are happening when it continues to make higher highs or lower lows in a downtrend, right? So higher highs, the percent R stays in the top few percentiles. Can't go above 100% on percent R. So it's just saying, look, if it keeps making higher and higher highs, you keep stretching that range, and that's the definition of a trend, right? So the point is that, okay, we catch that first leg. That gives us the flexibility to ride out a little retracement against us after we've sold half of the double. Free trade now, right? We're waiting it out, and then ultimately it goes up to almost 40 bucks. The 37 calls have to be worth about $3 there, and that's about where we're getting out. 279 is our target. So very thankful to do that, and right out right before it drops on back down. Do we know it's going to drop right on back down? Of course not. It could keep going. It could not, but it's about taking money slowly but steadily out of big trends in your favor. What about downside trades? It's flipped the script, right? It's look for the bottom breakdowns that tell us that the institutions are starting to pour on the selling pressure. And if they get wind that there's some bad news coming in Zillow, they're going to steadily sell this thing. It's not just going to be sold in one fell swoop, right? They don't want to splash all the water out of the proverbial pool as the 800-pound gorilla, right? The idea is that they want to slowly and steadily work their way out and not create too much of a price disruption. And so we get that signal that they're first starting their distribution activity here as it starts to have that first kind of quick pop down. It had been at 52. Now here it is about 50.5. And you say, well, to buy an option under $1, we've got to buy the 45 strike puts. That's like 10% out of the money, just a hair more than that. I said, man, that's asking for a lot. But remember, it doesn't have to get to the strike price. It begins that steady descent, dropping. As they say, stocks can take the escalator up and they often take the elevator down, right? The down moves can be much quicker and more dramatic. So you can see here that we're getting that steady decline, and our 100% target is being taken out right here, right? As it pops down here to about 48, maybe 47.5, right in that neighborhood. So you can see we've gone about halfway from the 50 level down to the strike price of 45. We're about halfway there at 47.5. As you can see, in retrospect, this trade does not get to the other target of 200%. As it comes back up, now as it's back up here about where we cashed in, this is not worth 100% anymore, right? Now we've lost several days worth of time, so that's going to be worth less. And as it kind of then ends up starting to retrace down into this other support zone here, we're saying, look, we're kind of losing the oversold status here, and we're kind of staying too much above that. So we say, look, let's just clean up the other half at a 23.6% gain. So, oh man, we were at 100, now we're only at 23.6. Well, the idea is that, look, we gave it a chance to keep going. It wasn't continuing to go, so it's still taking a profit on the second half. If you add the two halves up and divide by 2, that's 123% divided by 2. That's what results in about a 61% gain. Obviously, you can see on 18 contracts that you could have bought for $1,000 or less. That would make you $612 gross before commission, right? So the idea is give it a chance. If it doesn't go, you've still got a plan on how you can preserve your profit or chunk of profit. So this is why I'm called being a glass half full trader, because the way I look at it is, if I sell half at a double, I'm kind of good either way with what happens next, right? If it keeps going to a triple, I'm glad I still kept half my position on versus selling it all out at a double, right? If it gives up profit and ends up, in this case, from 100% back to 23%, I don't know about you, but I'm glad I sold the first half at 100%, right? Because I basically made more in that first half in that example, and then had a plan on how to manage the other to not let it totally slip away. So to me, it's kind of while trading is basically different shades of gray, it's not a black or white endeavor in my view. It's like there's a lot of things that can happen, right? You can't control all of those variables, but what you can control is how you're going to take money off the table gradually when it's working, how you're going to get rid of trades that aren't working more quickly without getting whipsawed, like I said, having the time stop, not the price stop. And then basically just knowing that we're going to be with you every step of the way to help you manage that, so you never have a question. You get constant support and access to me and my analyst team if you've got any questions about a given trade we called out. So like we said, how we get out of trades with time stops, if they're negative after the first trading day and a subsequent afternoon. So if I get a signal here at 11:30 in just under an hour, I will give it to the next trading day, which, now that we're on a Friday, it'd be the Monday next week, Monday afternoon. We would give it to that. That one day is the breathing room we give the trade. This ensures that we never get totally stuck in a slow mover or a mover against us, but it also ensures we don't get so many whipsaws like I showed you before. So we're giving it that breathing room. Then they've got to prove it to us that they're worth holding by moving in our favor beyond that, right? By each successive afternoon not getting whipsawed by a morning flush, right? So here's one that did not work, okay? This is MGM, the casino operator, and you can see breaking out on both of these together, this should go to the upside. You can see we started to go to the upside, and I don't know what the news was the following day. It was on a Monday midday. The following Tuesday morning, it pops down. We're thinking it might get a chance to get going back. It would have to get back up into here, right, by that afternoon. You can see that's not going to happen. It starts to recover a little bit, but not enough. We've dropped from 45.5 to about 44.5-ish. So we've lost about a point or about 2% of the stock. And you see that's meaning that we're getting knocked out at a 34% loss, losing $330 on 10 contracts, right? Because you buy 10 contracts, it costs you 960. We lose 330. So it happens, right? You have to be prepared for it. It will happen. It's not just could it happen, it will happen that you're going to get some trades that don't follow through. So we'll guide you through those, clean them up, and move them on. But the power of the system is that if you can keep your losses at something manageable like that, you say, well, a third, that's starting to get kind of to a more than a small loss, right? But I'm saying, look, if you're losing a third, but you're making 100, 150, 200, that you're like, okay, that's a good reward to risk, right? Even if you lost a half, you would still be way ahead of the game. We just want to try to avoid the big wipeouts. And we also don't want to get stuck just holding on to dogs that are just not performing, right? Because to me, again, psychology wise, you don't want to be in a problem mindset, always looking at big losers, always looking at what do I do next with a loser. I want you to clean those up, move those trades on when they're not doing what they're supposed to do, and get yourself back into the next opportunity mindset. I think we do that really well. It's why on our 25th year in counting, guiding folks through all kinds of different market conditions and trading opportunities with what to hold and what to get rid of. So ideally, of course, a trade is going to hit its 100% double target quickly, get your risk capital back in your pocket in the safety of cash, and let the other half ride till it gets to its final triple target, 200%. Here's one that got there with Caterpillar. Cat was not a dog. Cat was very good to us here. You can see that what I love about this is it shows you that when things go like they're supposed to go, you see the speed, right? The speed is obvious on this chart, right? It was going kind of grinding up the escalator, and then it's like it took the elevator up, right? It just went vertical from the moment we got in, right? It's just starting to take off. We're getting both of these together here, right at this kind of launch point here at about 250, 262 and a half. Again, we're going out about 10% up to the 290 strike calls, 28 points out of the money, right? But you're saying, okay, it starts to pop in our favor by the end of the day, then the big gap up the next morning. And so we're in this trade one day and out by the next afternoon. I mean, it doesn't get much better than that in terms of speed, right? Even though we're buying, this was in December, we're buying out to the third Friday in January. It's saying, look, we're not going to hang around and say, oh, there's got to be more money on the table, that we don't want to get rid of a big winner like this. It's like, no, we want to take, in this case, 107%, and then 201% on 18 contracts, made $1,476 before commission. So the idea is that take the money and run and keep stacking those gains as they're hitting, and not getting into that kind of a hold and hope mentality, right? That's where you start to let things slip away too much. You want to have a plan, you want to give it a chance to keep running, but when it runs to your second target, you take it out. So would you like to get real-time alerts on all of these trades that we call out for our home run options traders? I've set up this very special home run package for traders exclusive folks. So I'm going to walk you through this real quick, and then I'll come back and see if I can answer some questions. What I love about this package that my team and I have constructed for you is that it's not just a trade alert. It's not a black box system. It's not something where you're wondering what the heck are they thinking and looking at. We give you the education and the resources to truly learn the strategy, to where once you learn it, and you're gonna learn it, because I'm gonna constantly be reiterating it to you in weekly video training, as well as all the other educational bonuses I give you. You can find even more of these opportunities yourself if you care to. You don't have to ever spend a minute screen watching if you don't want to. We'll do that work for you. So all you have to do is be aware with your email, you're getting the real-time email, and you can also get it as a smartphone update via WhatsApp. Once you become a subscriber, we give you instructions on how to do that as well. So that's the easy way to make sure you never miss a trade. And then your job is simple. It's just execute. Where to get in, we tell you exactly where to get in, and then we tell you exactly where to get out. What I'm giving you is basically an opportunity here to say, look, let me give you not just a month to try it out, because I want you to have enough time to say, look, you've had 3 months of review here, just said, but I'm gonna give it to you at an extra special value here. $297 a month is what my subscribers would pay on my website. So 3 of those months would cost you $891. We throw in a bunch of other educational value, including a strategy session I did for new home run options traders. It takes you through the system in detail. The weekly video training I do every single Monday afternoon, it's posted early evening into your member site access. The settings and rules, valuable, right? You get that parameters of what to plug in for the various indicators, and then dedicated email to reach me and my fellow research analysts anytime you've got a question. Package value, in my view, is way over $1,000, but we show it 988 here, but I'm going to slash that down for you here. You know what? When you get all those goodies with that support, take that 988, cross it out. Instead of paying $1,000, if you act before midnight tonight, I'm going to take it down to just the price of 1 month, just $297. So $297 gets you 3 months, 90 days worth of access. You figure that out. Of course, that's averages out to about $99 a month, but I'm not offering it for a month at that, right? You're going to pay the $297 because I'm going to give you the details on the system, right? That's worth a lot. It's worth a lot more than a few $100 in my view. And the key here is that you can truly leverage this to be able to learn how to do it yourself, not just being given all the trading opportunities, which are plentiful that you will send you, but learning how to do it yourself is immensely valuable too. Where's the link there? It's members, and thank you, Sherry, for posting that. It's members.bigtrends.com/intro at the very bottom here of the page. Members, not www, mind you, but we want you thinking like a Big Trends member of the home run options trader service here, members.bigtrends.com/intro. So this is an introductory offer. Obviously, after 3 months, I think you're going to be willing to pay a lot more. But the idea is that, look, you can try it out for 3 months for $297 and truly test drive it and see the value that you can be generating. When you go to that order page, by the way, we're big believers in the KISS principle. The KISS principle in my trading, the simpler I keep it, the better I usually do. If I put too many factors on it, it ends up usually messing it up, right? So we want to keep things very simple for you in the ordering process too. When you go to that page, this is what it looks like. The key here to look at is that if you got any problems getting your order in on this secure page, you can call us toll free. If you can't remember that 800 number, remember it's 800 Big Trends, right? And client care at bigtrends.com is how you can reach us as an email. So make a note of those here. Write down 1-800-BIG-TRENDS and write down client care at bigtrends.com to yourself. Say, reach out to us if you've got any questions, taking advantage of this offer. which we just posted for you, but I'll remind you again. Notice also you can go bypass this page, secure page, if you want to put your credit card information there. On our 25th year doing business, serving people, keeping information secure, protecting you, as well as us. The bottom line is that, yeah, you can do it that way, or you can hit the PayPal link and it'll pop you to PayPal. You just have to then agree to the terms and conditions, which are hyperlinked and spells out all of our policies if you've ever got a question or an issue, how to handle that with us. But it's when you think about the value of what one trade can do for you, we showed you a number of examples where you could have made 1,300, 1,400, almost 1,500 bucks in a given trade that hits its double and its triple target. That one of those trades gives you like a 5-fold ROI on your $297 investment, right? Your ROI can be very quick and very dramatic, even with the fact that there was going to be losing trades. You know that we're going to help you manage winners and losers. We never leave you hanging. That's been one of my core principles. In addition to the principle that you always want to be green and growing, you always want to be learning. We give you tons of educational value here. So let me just, if you got a question, pop it in here real quick, but let me just remind you real quick before we get on to our next speaker. I got a great one coming up and a lot more to come as well. So stick with us all day here for a lot of great fellow traders insights here. But go to that page link and note it to yourself on your notebook right now. If you don't go there right now, you want to keep on learning here. I get it. I fully endorse that. But at the same time, I don't want you to miss out on this, because this offer is only going to be held out till midnight. So make sure you lock it in at members.bigtrends.com/intro for this introductory. For the price of 1 month, you're getting 3 months. You're basically tripling your subscription time value right off the bat. It'll be the first triple of hopefully many more to come with the double and triple targets that we have with the Home Run Options Trader system. Okay, and one more question here as we wrap it up. Do we look at Delta also, or only the price of the option? Great question. We watch Delta closely and Gamma, as I mentioned earlier. We watch the options Greeks, but I can kind of assure you that, when you're buying a cheap option, on some of the examples we showed you, like Williams, where it was an at the money option, your Delta is going to be near 50% to start off, and at the money is usually about a 50% Delta, give or take. So meaning that you expect a 1 point move in your favor gets you about 50 cents on the dollar. You paid $1 for the option, you get about a 50% gain on a 1 point move in your favor when it moves 50%. But the out of the money ones I showed you earlier, like Moderna, that might have been a 25% delta. It did not scare us away, because we believed that we could pick up the multi-point kind of dramatic move potential in our system set. We had a big, actually, Moderna is one of our best profit factors, actually. So remember, we do that profit factor filtering work too for you, so that if you were trying to do this yourself without looking at the history, you trade some names that you shouldn't be trading, right? So we'll screen that out for you to give you the best of the best. I'm out of time. It's 11 o'clock, ready for our next speaker. I'm gonna hand it back over to Sherry to get ready for our next great trader to share some more lessons with you. Thank you, Sherry, for having me. It's fun to always share what I've learned over 35 years of options trading.
Sure do appreciate when you can come, Price. I appreciate it a lot. Many thanks to our sponsors for the June live trader showcase, Market Taker Mentoring, TechniTrader, and Money Mentor. Please go check them out at markettaker.com, technitrader.com, and moneymentor.com. Thank you again.